Hello everybody, welcome to Sir Chua's Accounting Lessons PH, and today we will be discussing Statement of Cash Flows and the Notes to Financial Statements. At the end of the video, you should be able to discuss the nature and purpose of the Statement of Cash Flows, describe which transactions and effects fall under operating, investing, and financing activities, prepare a Statement of Cash Flows using the Direct Method, prepare a statement of cash flows using the Indirect Method, discuss the nature and purpose of the notes to the financial statements, and describe the order of presenting the notes to the financial statements. This is your lecturer, Kevin Troy M. Chua. Before anything else, please like, share, and subscribe to Sir Chua's Accounting Lessons PH and hit the notification bell button. Comment down your questions, suggestions, and reactions. Thank you very much for trusting Sir Chua's Accounting Lessons PH as your online learning partner. In the last lesson, we have discussed the Statement of Comprehensive Income and the Statement of Changes in Equity. And now we are to complete the complete set of financial statements, which is the Statement of Cash Flows and the Notes to the Financial Statements. And I think we're ready to start. Okay, so for you to review basic concepts of the Statement of Cash Flows on the approach for senior high school, if you want a foundational learning regarding this lesson, you can visit lesson 038, which is entitled the same, which is Statement of Cash Flows, and that's under the playlist of Fundamentals of Accountancy, Business and Management Part 2, also here in Sir Chua's Accounting Lessons PH. And the accounting standard that we will be using for today's discussion is IAS 1, Presentation of Financial Statements, and IAS 7, Statement of Cash Flows. Both of them can be accessed at www.ifrs.org. Let's start with the Statement of Cash Flows. This is the scope of the Statement of Cash Flows. An entity shall prepare a statement of cash flows in accordance with the requirements of IAS 7 and shall present it as an integral part of the financial statements for each period for which financial statements are presented. As you know, the complete set of financial statements include the Statement of Financial Position, the Statement of Profit or Loss and Other Comprehensive Income, the Statement of Changes in Equity, and the Statement of Cash Flows together with the Notes to Financial Statements. According to IAS 7 Paragraph 1, your Statement of Cash Flows is an integral part of the financial statement as well. So, without the Statement of Cash Flows, all of your financial statements will not be complete. Now, the following terms have been discussed and defined under Paragraph 6 of IAS 7. Cash comprises cash on hand and demand deposits. And then we also have cash equivalents, which are short-term, highly liquid investments that are readily convertible to known amount of cash and which are subject to an insignificant risk of changes in value. Now, for the inflows and outflows of cash and cash equivalents that will be reported in the Statement of Cash Flows, it's basically called the cash flow. And then, these activities, these three important activities in the preparation and presentation of the Statement of Cash Flows are also defined one by one. First is operating activities. Operating activities are the principal revenue-producing activities of the entity and other activities that are not investing or financing activities. So basically, if your activities are about the revenue producing activities of the entity, like purchasing of your goods or purchasing of raw materials or payment of your expenses so that you can continue operating, then those are operating activities alongside the cash that you receive from rendering services or selling of goods. Those are operating activities because they are related to the principal revenue-producing activities of the entity. Investing activities are the acquisition and disposal of long-term assets and other investments not included in cash equivalents. Now, investing activities actually relate to the non-current asset section of your Statement of Financial Position because it includes all of the cash flows that are related in the case that we are selling our equipment, or we are acquiring equipment, or we are selling investments, or we are purchasing investments. So basically, all of those are part of your investing activities, which are actually related to the balance sheet non-current asset section. And then for your financing activities, these are related to the items in your statement of financial position relating to the non-current liabilities and equity section, because these are activities that result to change in the size and composition of the contributed equity or borrowings of the entity. These include your issuance of share capital in which you receive cash, or maybe you borrowed through a loan or bonds payable. So you get cash from those activities, and those are not operating activities because those are not revenue producing activities, but you regard them as financing activities because you get cash from them. Aside from the cash that you get from your operating activities, you get cash from issuance of your share capital, you get cash from loans or bonds payable, and then once that you repay also those bonds and those loans, then that is also a cash outflow from financing activities. So those are the terms that are being defined in IAS 7. The statement of cash flows shall report cash flows during the period, classified into three: those operating, those in investing, and those in financing. So later on in our discussion of the statement of cash flows, we will be presenting how to prepare a statement of cash flows that is being segregated into these three activities, which is operating, investing, and financing activities. Now, according to IAS 7, paragraph 14 to 15, these are some of the examples of operating activities of the entity. So the first one is cash receipts from the sale of goods and rendering of services. So if you sell something or if you render your services to customers, you get cash from it. That's a cash inflow. And then cash receipts from royalties, fees, commissions, and other revenue. So other revenue that you have, when you get cash from it, it's also an operating activity. Or more so with our payments, cash payments for suppliers for goods and services, cash payments to and on behalf of employees. Best example is payment of salaries to your employees. And then cash payments or refunds of income taxes, unless those income tax effects can be identified with financing and investing activities. But basically, the general rule is that you are paying taxes because you are operating. So that's why your payments or refunds of income taxes forms part of your operating activities as well. And then cash receipts and payments from contracts held for dealing or trading purposes, that also forms part of your operating activities. Basically, they are from the main revenue generating activities of the entity. Now, some transactions, such as the sale of an item of plant, may give rise to a gain or loss that is recognized in profit or loss. It's included in PL. However, the cash flows relating to such transactions are cash flows from investing activity. So later on, when we will be preparing your statement of cash flows, the effect of the gain or loss in the sale of plant assets will be eradicated in the cash flow from operating activities, and then the cash that you receive from the sale of those plant assets will just be part of your investing activities. Later on, you will be understanding it when we have numbers already. Now, also the standard tells us that cash payments to manufacture or acquire assets held for rental or others and subsequently held for sale, as described in paragraph 68A of IAS 16 PPE, that should also become part of your cash flows from operating activities. So you need to be wary of that because it's held for rental. And as you know, when you receive something from your rental, that's actually operating activities. So if those assets are held for rental or subsequently it was held for sale, that's actually forms part of your cash flows from operating activities. The cash receipts from rents and subsequent sales of such assets are also cash flows from operating activities. Any entity may hold securities and loans for dealing or trading purposes, in which case they are similar to inventory acquired specifically for resale. So if you are holding it for trading purposes, if you are holding it for resale, those will be regarded as operating activities as well. And then, cash advances and loans made by financial institutions are usually classified as operating activities since they relate to the main revenue producing activity of the entity. So as you can see, cash advances and loans, the first thing that you would come into your mind is it's a financing activity. However, if we are talking about a financial institution, because that or those are their main revenue producing activity, then cash advances and loans will form part of their operating activities instead of financing activities because that's what really they do. Okay, so those are your adjustments or something that we need to clear regarding operating activities. Now, these are the examples of investing activities in IAS 7 according to paragraph 16. When you are paying or acquiring PPE, intangibles, and other long-term assets, those are investing activities. Or in any case that you are selling your PPE, intangibles, and long-term assets, those are also investing activities. But if your inventory includes equipment, you are selling machinery as part of your inventory, then that becomes operating activities because those are main revenue generating activities that you have. But if you are actually using your PPE or your machinery, your equipment for your operations, but then suddenly you sell it, then it becomes a cash inflow for investing activities. And then cash payments and receipts, that is related to equity and debt instruments of other entities and interest in joint ventures. And then cash advances and loans made to other parties. Take note that we are pertaining to loans made to other parties, not loans that are liabilities or obligations of the company, because that will really form part of your financing activity. So we're talking about the advances and loans made to other parties because those are actually investments. Okay, and then cash receipts from the repayment of advances and loans to other parties, and cash receipts and payments related to futures contracts, forward contracts, option contracts, and swap contracts, unless they are for trading purposes. Because if they are for trading purposes, it will form part of your operating activities. Okay, so those are your investing activities. Now, according to paragraph 17 of your IAS 1, these are your financing activities examples. Cash proceeds from issuance of shares and other equity instruments, and cash payments to owners to acquire or redeem the entity shares. You also have the cash proceeds from the issuance of debentures, loans, notes, bonds, mortgages, and other short-term and long-term borrowings, and then cash repayments of amounts borrowed, and cash payments by a lessee for the reduction of the outstanding liability relating to a lease. So always remember that when your transactions are related to the non-current liabilities and equity section, sometimes, or not really sometimes, but most of the time, it forms part of your financing activities because it roots from the idea that the company is generating money because of these activities that are not main revenue generating activities of the company. Okay, so those are your financing activities. Now, an entity shall report cash flows from operating activities either with the use of the direct method, in which you really specifically tell if it is a cash receipt or cash payment for whatever activity it might be. Now, for the indirect method, you will start with the profit or loss or net income, and then you will be doing some adjustment. Okay, so later on, I will be presenting you both how to prepare a statement of cash flows using the direct method and how it is when you will be preparing it under the indirect method. And for those who are graduates already of senior high school, I know that this has already been discussed with you during your grade 12. So I don't think that this is your first time to prepare a statement of cash flows. Okay? Either way, I will be discussing it to you fully. An entity shall report separately major classes of gross cash receipts and gross cash payments, arising from investing and financing activities. So it's like the standard tells us that we really need to be specific in the reporting of our investing and financing activities, and you will notice that later when we will be preparing your statement of cash flows, because operating activities are given actually the option to present it using the direct method or the indirect method, but in your investing and financing activities, the standard tells us to present it specifically on the major classes of gross cash receipts and gross cash payments relating to those activities. So basically, it looks like it's direct method when you present your investing and financing activities. Now, cash flows arising from transactions in a foreign currency shall be recorded in the entity's functional currency by applying the exchange rate applicable at the time of the cash flow. The cash flow of a foreign subsidiary shall be translated at the exchange rates between the functional currency and the foreign currency at the dates of the cash flows. Now, for unrealized gains and losses arising from changes in foreign currency exchange rate, do not regard it as a cash flow because that is only an exchange rate adjustment or exchange rate difference. What you need to do is you need to present it separately, and that separate presentation looks like this. It's not part of your operating, investing, and financing activities, but you will have a separate line item before you get the ending balance of cash, which is called the effect of exchange rate changes on cash, because it's not literally a cash flow, it's just actually an adjustment because of the exchange rates that we are using. Okay, so you present it separately as a line item, but do not include it in any of your operating, investing, and financing cash flows. Okay, so that's how you do it. Now, for interest and dividends, interest paid and interest and dividends received are usually classified as operating cash flows for a financial institution because, as you know, that's their main revenue generating activity. However, there is no consensus on the classification of these cash flows for other entities. So actually, the standard tells us that we have a choice in presentation. So first one is interest paid and interest and dividends received may be classified as operating cash flows because they are presented in PL. And as you know, when you present something in PL, that's actually operating. So if you have interest expense, or you have interest income, or you have dividends that you pay to your shareholders, then you can choose to present it using the operating activity section. However, the standard provides us an alternative, which is interest paid can be presented as a financing cash flow because, as you know, when you are paying for interest, it's actually related to any loan or bonds that you have. And as you know, loans and bonds form part of financing cash flows. So the thing is, you are actually paying for interest because you have loans and bonds. That's why you have an alternative to present your interest paid as financing cash flows. And then for your interest and dividends received, you can also present it on investing cash flows because interest income sometimes arises from any investments in debt instruments. Or you also have dividend income because you have investments in associates. So what happens is, what happens is that, like for example, in investment in associates, so it's actually rather a return of investment rather than recognizing it as dividend income. So if you have dividend income coming from other investments, it can also be reported as investing cash flows because what do they root from are actually some items that you present in investing cash flows. Okay, so those are the two alternatives, but basically as how I see it, practically we usually report your interest expense and your interest income and dividend payment and dividends received rather in your operating cash flows because they're actually part of your PL. And if you report or present your statement of cash flows using the indirect method, what happens is that it forms part naturally of your income statement. It forms part naturally of your net income, so you don't have many adjustments to do on that. However, dividend that is paid to shareholders, then that's the time you actually present it as financing cash flow. For those dividends that you pay to your shareholders, it usually forms part of financing cash flows. So those are the things that you need to remember in interest and dividends. And then just to clarify what I've said earlier, dividends that you received from investment in associates are actually return of investment because, as you know, the entry is debit cash credit the investment account. Okay, so you actually have an alternative to present it as investing cash flow because it relates to the investment associate. And as you know, investment associate is the cash that you use to acquire that becomes an investing activity. Okay, so I hope that we are clear on that. Okay, now for taxes on income, cash flows arises from taxes on income shall be separately disclosed and shall be classified as cash flows from operating activities unless you have tax effects that can be specifically identified with investing or financing activities. And then always remember that we have non-cash transactions that can affect your net income and your financial position, but it cannot be reported in your statement of cash flows because it's non-cash. Investing and financing transactions that do not require the use of cash or cash equivalents shall be excluded from a statement of cash flows. Such transactions shall be disclosed elsewhere in the financial statements in a way that provides all the relevant information about these investing and financing activities. So those non-cash transactions that are investing and financing activities in their nature, it shall be disclosed by the entity. So the examples of those are the acquisition of assets either by assuming directly liabilities or by means of a lease. So if you purchase equipment or if you purchase machinery but you had it on a liability rather than paying cash directly, then that is a non-cash transaction. But as you know, when you acquire those assets, that's actually an investing activity. It's an investing activity, but it's non-cash. Or the acquisition of an entity by means of equity issue. So you want to acquire another company, but you just issued shares rather than paying cash for it. So those are actually related to investing and financing activities, but there is no cash involved. Or when you convert that to equity, there is also no cash involved, but it's actually an investing and financing activity in its nature. Okay, so you just have to disclose that, but you don't have to present it really in a statement of cash flows because after all, those are non-cash transactions and we don't have any cash flow expected from that. So you don't report that in the statement of cash flows in itself. Now, an entity shall disclose the components of cash and cash equivalents and shall present a reconciliation of the amounts in its statement of cash flows with the equivalent item reported in the statement of financial position. So the thing here is that you present the beginning and ending cash balances in the statement of cash flows. That's the reconciliation that we are talking about. And also the cash and cash equivalent components should also be disclosed in the statement of financial position, notes to the FS rather, and then you present the total amount in the statement of financial position. Okay, so let's now move on to our theories about the notes to FS. Okay, so the notes shall present information about the basis of preparation of the financial statements and the specific accounting policies used. So basis of preparation and then the accounting policies used. And then you also disclose the information required by IFRSs that is not presented elsewhere in the financial statements. So if your if a specific IFRS rather requires you to disclose something, you will be following the disclosure requirements in that IFRS or in that standard, and then you properly put them in the notes to the FS and then provide information that is not presented elsewhere in the financial statements. So if it would be relevant to the understanding of the FS itself, when you don't report it in the financial statements, then you report it rather in the notes to FS, because if it's needed to understand or for the reader to understand the items in the FS, then you need to disclose it if it's not in the face of the FS. Okay, so an entity shall, as far as practicable, present notes in a systematic manner. And how do we say it's systematic? The entity shall consider the effects of understandability and comparability of the financial statements. So you can only say that the notes are presented in a systematic manner when it's understandable and comparable. And those are the things that you should think about or put into your mind. That when you are preparing your notes, it should promote understandability and comparability. Also, the entity shall cross-reference each item in the statements of financial position and statements of profit or loss and other comprehensive income, and in the statement of changes in equity and of cash flows to any related information in the notes. When we say cross-referencing, if you say that your cash in your 2020 balance sheet is 200,000, when you report the details of those 200,000 cash in the notes to the FS, make sure that number one, you will be able to represent all of the components of that 200,000, and that it should also correspond with that total 200,000. So what we are avoiding is that we have erroneous cross-referencing, that your cash in the face of the balance sheet is 200,000, but in the notes it's only 175,000. Okay, so the standard tells us that in the preparation of your notes to FS, it shall be properly cross-referenced. If you presented the details of your operating expenses and it's 1 million in total, then your operating expenses in your income statement should also be 1 million as presented in the FS or in the face of the FS. That is the requirement as to your structure. An entity shall also disclose its significant accounting policies on the measurement basis that is used in preparing the financial statements, like FIFO, weighted average, so those are the measurement basis, or any accounting policies used that are relevant to the understanding of the financial statements. An entity shall disclose, along with its significant accounting policies or other notes, if they have any judgments apart from involving estimations that the management has made in the process of applying the entity's accounting policies that have the most significant effects on the amounts recognized in the FS. An entity shall also disclose information about the assumptions it make about the future, and you should also disclose their nature and the carrying amount of those assets and liabilities as part of your assumptions. An entity shall disclose information that enables users of its financial statements to evaluate the entity's objectives, policies, and processes for managing capital. Now, the standard specifically tells us that these items should be disclosed in the notes. The amount of dividends proposed or declared before the financial statements were authorized for issue, but not recognized as a distribution to owners during the period, and the related amount per share, dividends per share, and then the amount of any cumulative preference dividends that are not recognized. So that's specifically mentioned in the standard. We need to follow that. And then also, there should be also a disclosure of the domicile and legal form of the entity, where it's incorporated, what country, and the address of its registered office or principal place of business. And then the nature of the entity's operations and its principal activities. So you have to tell a story, a bit of a story about what does the entity do, what are its principal activities, what is the nature of the business, how do they earn, something like that. And then the name of the parent and the ultimate parent of the group, as in the cases of consolidated financial statements. And in any case that a company is a limited life entity, you also provide information regarding the length of its life. Okay, so we're now ready to discuss problems, and allow me to present to you how to prepare a statement of cash flows. So for our problem this session, you need to look at these given first, and I suggest maybe that you get a screenshot of them so that you can go through it again later. And I hope that after discussion of this in our session today, you also try to answer it, also try to practice it using the given that we will be providing here. Okay, so here it is. Let's start. The statements of financial position of impressive company as at December 31, 2020 and 2019 are provided as follows. So you are given a comparative balance sheet, and then also you are given the following. The statement of comprehensive income of impressive company for the year ended December 31, 2020 is also given to you here. And then some other information for 2020. So for these relevant information, we have depreciation of buildings and equipment, which is 60 and 30,000. And then the entity sold an equipment worth 80,000 with accumulated depreciation of 10,000 at that time, but they only sold it for 40,000. Okay, and then we have issuances of long-term bonds in exchange for a land that the entity is targeting to get, which is 1,100,000, and they also issued ordinary share capital for cash, which is for 200,000. They also paid cash because they purchased building and equipment, which is 1,200,000 and 250,000 respectively, And then cash dividends declared and paid to our shareholders is 290,000. The requirement for you is to prepare impressive company statement of cash flows using the indirect method and the direct method. If this is not your first time preparing a statement of cash flows, I suggest that you pause the video first, then try answering this, and then try to create or recreate rather the statement of cash flows for this company, and let's see if you have the correct answer, if you get it correctly. Okay, but if you feel that you're not yet confident enough in preparing the statement of cash flows, then let's start our discussion. Okay, let's first discuss your indirect method. We start with your cash flows from operating activities. I am omitting for now your heading because you know how to present that heading, so I'll just be presenting it later. Okay, now for your cash flows from operating activities, you actually start with the net income that is presented on the statement of comprehensive income of 1,450,000. That is always the starting point when you are presenting your statement of cash flows using the indirect method. Now, you will now be doing an adjustment on all of the non-cash transactions that affected your net income. So the first one is, if you will be looking into the other information, we have depreciation of your buildings and equipment, which is 60 and 30,000. So you add that back to your net income because that is a non-cash expense. Okay, now the total depreciation expense, which is 90,000, you can see that in the income statement it's really reported there as depreciation expense of 90,000. And then as you can also see, we have here an equipment with a carrying value of 70,000 that was only sold for 40,000. So in the income statement, you can see a loss on sale of plant assets, which is 30,000, and you have that re-added to net income as well. Okay, so the sum of all of these items that we adjusted from net income is called operating income before working capital changes, or operating income after re-adding or readjusting your non-cash transactions. Okay, and then we proceed with the changes in financial position. We first report your decrease in accounts receivable. We add any decrease in accounts receivable because if your accounts receivable decrease, it means that the company got cash from that, right? So if your accounts receivable decreased, the expectation to receive something goes down because you already received that cash from customers, so you need to add that. And then any increase in inventories will be deducted because there are two factors that affect increase in inventories. It's either number one, you're not yet selling those inventories, that's why it does not become cash up until now, or your inventories increase because you purchase inventories. Okay, so that's also the reason why you need to deduct any increase in inventory. And then you also deduct any increase in prepaid expenses because when your prepaid expenses increase, it means that you have purchased additional prepaid expenses that are not yet expiring. So that's actually a cash outflow in its sense. So you need to deduct that as well. Okay, so we're done with the current assets section. Let's proceed now to your your current liabilities rather. Current liability section. So in your current liabilities, you will make your mind's opposite on its analysis. So what happened to your accounts payable? It increased. Any increase in accounts payable means that you are holding back cash because you're not yet paying these payables for now. So that's why it increased, because you're not yet paying them. That's why any increase in accounts payable is being added. And then for your income tax payable, from 80,000 it went down to 60,000. So when your income tax payable went down or it goes down, you deduct it because you paid for taxes. That's why your payable went down, because you paid for taxes, and that's a cash outflow. Okay? So when you're done with adjusting your items on current assets and current liabilities, basically your working capital changes, then you can get now your net cash flow from operating activities of 1,720,000. When you're done with the operating activity section, you're ready to present your investing activity section. we start with the proceeds of sale of equipment. So as you know, we have already adjusted in the operating section, operating activity section rather. Operating section, it sounds like we're a hospital. Okay, so we already adjusted the loss a while ago in your operating activity section. So now here in your investing activity section is we have a selling price of 40,000 for the equipment that you sold. So that is a cash inflow from investing activities, which is the proceeds from the sale of your equipment, which is 40,000. And then look here, you also have purchases of building and equipment. So that's a cash outflow because you purchased new assets. Okay, so your purchase of building and equipment will be presented negatively because that's a cash outflow. You purchased the building, that's why you have a cash outflow of 1,200,000, and you purchased an equipment, that's why you have a cash outflow of 250,000, and that forms part of your net cash flow from investing activities. If you're done with your investing activities, then you're ready now for your financing activities. Now, for your financing activities, as you can see here, you have an ordinary share capital that you receive cash because you issued shares. So that's a cash inflow because you got cash from the issuance of shares, 200,000. And then you paid dividends to your shareholders worth 290,000. That is a cash outflow related to financing activities. Okay, so I think that would be all, and that is your net cash flow from financing activities. Now, if you complete all three, then you analyze what happened. If you have now your operating, investing, and financing activities, you can now get your net cash flow. So positive 1,720,000 minus 1,410 minus 90,000 will give you a net cash flow of 220,000. Now, if you will be looking into your balance sheet, the starting balance of your cash is 330,000, and it should correspond with the ending balance of your cash and cash equivalents in the balance sheet, which is 550,000. Now, in note disclosure, you should disclose this. As you can see, we issued long-term bonds, but we purchased land on that transaction. So there is no cash involved, but it's actually you issued long-term bonds, so that is a financing activity but non-cash. But you purchased land using those bonds, which is an investing activity that is also non-cash. So you report it in the notes, any non-cash investing and financing activities for 1,100,000. And don't forget that you need to put your heading, Impressive Company Statement of Cash Flows, December 31, 2020. And that's how you present your statement of cash flows using the indirect method. If you're ready, we can continue with this video, and let's present the Impressive Company Statement of Cash Flows using the direct method. So in the transformation of your records to cash basis, you just go back to your concepts that we have discussed in cash to accrual basis of accounting. But because the statement of cash flows is the only financial statements prepared under the cash basis of accounting, you will reverse all of the equations that you learned in the cash to accrual basis of accounting, because you will now be transforming it from accrual basis to cash basis records. Okay, so this is what we do. If the beginning balance of your trade accounts receivable is 300,000, and then you add your sales on account, which you can see that actually in your income statement of 5,070,000, then your ending balance in your balance sheet is 200,000. You squeeze the amount of collection from customers, which is 5,170,000. Okay, so since that is the cash transaction related to your receivable, later on that will be presented as a cash inflow due to collection from customers. Now, related to inventories, what you do is the beginning balance of your inventory, and then any purchase that you made, and then you deduct cost of goods sold so that you can get the ending balance of your inventory. And then you squeeze this equation so that you can get the purchases that you did or that you had during 2020. The amount of purchases that you had during 2020 will now be used in this equation. the beginning balance of your accounts payable, and then you add the 1,550,000 purchases that we made, and then we have ending balance of accounts payable of 280,000. So you can squeeze the amount of the payments that you had in paying for your accounts payable or for paying for your merchandise inventory. So later on, that will be presented as a cash outflow due to purchases or due to payments of accounts payable. And then for your prepaid expenses, that's the beginning balance. And then remember that we have expiration of prepayments, which is presented as your operating expenses. And then the ending balance of your prepayments. You squeeze the amount of cash payments made to purchase or to get new prepayments. So that's 1,150,000. That will also be presented later on as a cash outflow for payments of expenses. And then for your income taxes, it started with 80,000, but the expense this year is 470,000 as mentioned in your income statement. If the ending balance of your income tax is 60,000, you can squeeze the amount of payments that you did during that year, which is 490,000. So later, you will be presenting that as cash outflow from payment of taxes. And then we have specifically a payment for interest expense in which we don't have any accruals or deferrals regarding this one. You can see that in the income statement, which is your interest expense in itself of 420,000. So coming from that information, you can now present your cash flows from operating activities using the direct method. So as you can see here, allow me to use your laser. So that is the collection of customers of 5,170,000. You paid for purchases and accounts payable of 1,390,000. You also paid for your expenses of 1,150,000. You paid for your taxes of 490,000, and you paid for your interest of 420,000. And as you can see, we also got the same amount in the indirect method, which is 1,720,000. And that's how you prepare the cash flow from operating activity section, but now using the direct method. Let's proceed to the investing activity section. So if you analyze the T account of land, you have a starting balance of 200,000, and then you acquired something, but in the other information, you don't have any disposals, so ending balance is 1,300,000. But as you noticed earlier, your 1,100,000 acquisition of land is not actually a cash transaction. This is a non-cash transaction a while ago, so you don't put that in your investing activities, okay? And then for your building, we don't have any disposals of building, so you just squeeze out the acquisition. But actually, you can also see this 1,200,000 in the other information a while ago. And then for equipment, you just adjust it with the disposals made. So beginning balance plus acquisition, and then you have your ending balance. You squeeze your acquisition here, which is 250,000, and that also corresponds to the other information that we had earlier. And then you also analyze the T account for your accumulated depreciation so that you will know and you will be able to determine how much accumulated depreciation is related to the asset that we disposed. So coming from that, if the cost of the disposed equipment, this one, which is 80,000, and the accumulated depreciation for that is 10,000, then the carrying value of the disposed equipment is 70,000. However, you got a loss of 30,000 in your income statement, so you can work back with how much you sold it, which is 40,000. Okay? Guys, always remember that in actual practice, we are not given of all those information, and we really need to squeeze all these information only coming from the records. That's why I am not actually referring to the amounts that we presented in the other information a while ago. What I am presenting you is working back with your T accounts and with your calculations to be able for you to get any cash flow regarding with these transactions. Okay, so if you already have these information, then you can present now your purchase of building, which is 1,200,000, and then your purchase of equipment, which is 250,000, and any proceeds that you get from the sale of your equipment, which is 40,000. And again, this 1,100,000 increase in land is a purchase of land because of a non-cash activity, which is issuance of bonds. Okay, so you don't present that here in your investing activities. And then for financing, we will be analyzing your equity components. So the beginning balance of your share capital is 500,000, and if the ending balance is 700,000, then if the entity knows that there are no retirements that have happened, so the difference will just be your issuance of share capital. And then your retained earnings beginning, and then you add your net income coming from your income statement. This is your retained earnings ending. You can work back with your dividends that you declared and subsequently paid during the period, which will form part now of your cash flows from financing activities. Issuance of ordinary share capital for cash, which is 200,000, and the payment of your dividends, which is 290,000. So as you noticed, I am actually using here your records and not the other information that we presented earlier, because that's how you actually do it in actual practice. So if you already have those all components, then this is how your statement of cash flows would look like under the direct method. And as you can see, the only difference in direct and indirect method is the presentation of your cash flows from operating activities. So I hope that you understand our lesson regarding the statement of cash flows. Now allow me to show you some examples of the notes to financial statements. This is not a very comprehensive example, but I just want you to have a glance on it, on how it really looks like in actual practice. Okay, so one thing that the standards tells us in IAS 1 is that we should give general information, status of operations of your company. So basically, you tell the name of the company, and is it a subsidiary or majority owned subsidiary, and then is it registered elsewhere, or what is its registration number in SEC, and then what is its line of business. Now for the company that I use, it actually relates to insurance, and then it's also registered with a BIR here in the Philippines, and its tax identification number, and then the principal place of business, and then how many employees, and when are the financial statements approved and authorized for issue by the board of directors. Okay, and then the notes to financial statement should also present to you the financial reporting framework and the basis for preparation and presentation, as what we have discussed a while ago, which is, according to the notes, they use the PFRS, which encompasses your PAS, and all of the interpretations like PIC and IFRIC, which is approved by the FRSC of BOA and adopted by SEC. Okay? And then the notes rather should also present any adoption of new and revised accounting standards, because those are disclosures of the accounting policies that you used, and also you will be summarizing the significant accounting policies that is being applied in the entity. And then you also present any critical accounting estimates and judgments. So a while ago, I told you that whenever there are judgments and estimations that the company has made during the period, then they also should be able to disclose that in the notes to FS. And then we also have here financial risk management objectives and policies that the company has. And then for the details of the amounts that is presented in the face of the financial statements, that's what I've told you earlier, it should be properly cross-referenced. So in this company, their cash at the end of the period is 1,095,680, in which the components in 2016 is cash on hand of 9,436 and cash in bank of 1,086,244. However, this 1,095,680 should correspond with the cash in the balance sheet of this company. It should be properly cross-referenced, so it should amount with 1,095,680 as well. And then you provide other information like any bank interest rates that they earned, and then if there's any restriction, basically it should not be reported as cash and cash equivalent, something like that. So as you can see in the notes of financial statements, we are just explaining everything. We are just explaining what you presented on the face of the FS, and if you can present it on the face of the FS, that's the time that you presented in the notes to FS. This is also an example of any prepayments and other current assets that the company has. So as you can see, this amount should be able to be equal to the face of the FS 1,114,316. And then any information like input value added tax or writing off of your input VAT, and so on. Okay, note 15 is actually your BIR information. And then you also present how you get your property, plant, and equipment as to their original cost and accumulated depreciation. And then basically cost less accumulated depreciation, that is the carrying amount at the end of the period, which is presented on the face of your FS. You also provide them information about your liability. So I'm not presenting actually the totality of the notes here. I'm just presenting you some examples, and as you can see, they really detail everything, and then this total will just be the one to be presented in your FS. And then these are the operating expenses of the company: salaries, professional fees, rent, transportation and travel, representation, communication, and so on. So this total amount of expenses is presented in the income statement. And then in any case that you have foreign currency denominated monetary assets and liabilities, you also explain where they come from, what is the exchange rate that you used, and the proper detailing of all those transactions in foreign currency. So those are just basically how you present your notes to financial statements. But if you are curious on how it really looks like on the totality of an entity, you can actually download any company that you are, or download rather the annual report of any company that you are interested into. Then you go to the financial statement section, and from that you can see the totality, not only of the financial statements, but how many pages actually are the notes to FS. And actually sometimes notes to financial statements in itself comprise of 100 pages, because you explain everything there that is being presented in your statements or in the face of your statements. Okay, so that's our discussion of the statement of cash flows and the notes to financial statements. And our next lesson is interim financial reporting and segment reporting. Again, please like, share, and subscribe to Sir Chua's Accounting Lessons PH, and hit the notification bell button. Please comment down your questions, suggestions, and reactions. This has been Sir Chua's Accounting Lessons PH. To God be all the glory, honor, and praise. Thank you, and have a great day.